is a private equity firm with about $2.5 billion under management. We have two strategies, the direct lending and private equity side, control side. We're based in West Palm Beach, Florida, and generally focused on deals that are a little outside the box, things that are a little different. On the lending side, we're split between sponsored and non-sponsored. We have a long tradition of investing in the non-sponsored space. And our roots are as a merchant banker. So our roots are 25 years ago. So we really have an appetite for underwriting risk that others sort of cast out quickly. So that's our latest fund on the credit side is $450. Typically investing $10 to $40 million per transaction, investing in companies with 3 to 20 million of EBITDA, which we define as lower middle market. Everyone has their own definition for middle market, lower middle market. But that's generally where we invest. So we're here to, with that, we'll kick off the talk, and appreciative of the guys coming together here. I think we've got good timing, if nothing else, in terms of talking about the topic. So I'm going to start with just introductions and who we are, so you know kind of what parts of the market we're each focused on, and then we'll get into a little overview of the industry and where we are now before we get into talk about the market and where we're going. So again, I told you about Comvest. By way of background, I've been in the lower middle market for about 20 years as a lender, starting at Heller in the late 90s. Most of that time has been spent at Comvest the last 5 years. Before that, I was part of a team that built Dymus Capital, which was part of Cerberus. We were there for 7 years. So things that are a little outside the box, things that are a little hairier, is what's more or less defined my lending career, and then dealing with them. So that's where I've been. Jason, you want your background?
Sure. Jason Van Dusen, Golub Capital. I've been there about 6 years, and I run the cap markets team there. Golub Capital is an asset manager. We manage now a little over $15 billion of debt. We play a pretty broad spectrum now. We're probably relevant from $5 million of EBITDA in certain industries up to $100 million of EBITDA, doing some larger market LBOs. You know, we're an asset manager, so we're kind of, I'd say we're in the box. We're trying to do stuff that is more in the fairway. We try to find great credits, and some people may argue we over-lever them. But I think our loss history proves that that's a better way to play it than chase yield, in our opinion. We primarily cover sponsors, so 95% of our deals are sponsors. And where we're playing right now is mostly senior debt and unitranche. The firm has changed quite a bit. It's 20 years. While we still have, someone brought up SBIC licenses, and we still have some small junior capital investments. For the most part now in new deals, we are playing senior debt and unitranche, although we do large equity co-invest, and we take board seats and are active partners with management. But that's Golub Capital in a nutshell.
I'm Bob Long. I'm the president of Star Mountain Capital. Star Mountain has $500 million of assets under management. We focus on the lower middle market, particularly the credit space. For us, lower middle market is $3 to $15 million of EBITDA. I think I was invited to the panel because prior to joining Star Mountain very recently, I was the CEO of OHA Investment Corp, the BDC sponsored by Oak Hill Advisors. And prior to that, I ran Conversus Capital, which was the largest of the listed fund of funds.
And I'm Bob Horak. I co-head the debt advisory group at Lincoln International. For those of you who don't know Lincoln is a middle market investment bank. We do a lot of sell-side M&A, capital raising, which is where I spend my time, as well as restructuring and valuations. Lincoln's activities are split about 2/3 in M&A advisory. We have 16 offices around the world, 400 investment bankers. We cover 15 or 16 industry groups through our M&A business, and we were the #1 seller of businesses for private equity in 2015. The debt advisory business comprises most of the rest of Lincoln's activities. We have 25 people solely dedicated to doing financings, executing financings. It is primarily for sponsors. About half of our debt advisory people are in the U.S. and half are outside the U.S. And last year we placed over $3 billion of capital, again, primarily with sponsors in businesses that generally are between 10 and 40 or 50 million of EBITDA, but we'll talk about this, I'm sure, on the panel. More recently, we've seen some opportunities in the $50 to $100 million EBITDA segment as well.
Kevin Griffin with MGG Capital. Just by way of background, started my investing career at American Capital, one of the first publicly traded BDCs out there. Spent times at Fortress and Highbridge helping build those credit platforms. Launched MGG about 18 months ago. We're, again, focused on the lower end of the middle market, which we're defining as 10 to 40 million or so of EBITDA. Doing mostly non-sponsored transactions. We'll do some sponsored type deals, but for the most part, like a little bit of a hairier story, a little bit off the run type credit. We look to invest anywhere from 10 to $75 million in any one credit. Fairly industry agnostic, have not played in the energy and oil space, although that might be becoming more in vogue, because that's obviously a hairier space. But in general, we're agnostic across industries and platforms, typically more in the senior secured part of the capital structure. I like to be through $1, and so we do mostly unitranche, stretching into situations that maybe require a little bit of senior capital as well as some junior capital.
Great, thank you guys. So before we get started, I wanted to give a quick overview of the BDC space and some of how it's developed, so we all sort of have a level set on how we got here, and then we can talk about where we're going and open it up to the panel for thoughts on the market today. So the BDC industry has really grown the last 15 years. You sort of forget this when you sit today. In 2000, there were about 10 BDCs. You had a period of significant growth through 2007 and 8, where we had about 25, and then another period of significant growth in 13 and 14. And so what you see here is gone from 10 BDCs to about 40 BDCs public, and an asset class that's grown significantly, become a significant part of the sponsor finance market over time. If those of you who follow Jonathan Bach, and if you don't, I would suggest you do. He had a really interesting piece yesterday comparing the BDCs to REITs and MLPs, the development of those markets. And his point was those markets have grown to levels where we just know them as institutionalized markets today, but at different points in time over the last 30 and 40 years, they went through growing pains the way the BDC is going through today. So long term, this growth should continue, but obviously we'll talk about where we are today. Here we've got asset growth, so again, this really impressive growth in the space. This includes the leverage that BDCs use. It also includes some of the non-traded BDCs, or includes the non-traded BDCs. And the thing I just point out here is you can see the spike in 13 and 14. Those of us in the market know that was a tough time from a vintage standpoint in the market. Leverage was high, pricing was low, structures were weak. So that's a tough time to be building a book that weathers the cycle as we think about where we're going, where we are today and where we're going. So that's led to some struggles. This is the trading patterns over the last 5 years. You can see that for about the last 18 months, they've been trading, BDCs as a sector have been trading below 1.0. And you see the trough in January. It's come up off the trough, thankfully, but still trading below 1. Liquidity is constrained for BDCs that are reliant solely on the public vehicle for their liquidity. And we'll talk a lot more about what that means. But if you look at it by size, the market clearly distinguishes between smaller and larger BDCs. The larger BDCs are generally, the market views as investing in larger companies, which they view as better credit quality. And they're institutions that have several different pockets of capital, so they have more, the platforms are more substantial. So there's clearly a premium. For the smaller BDCs, for many of them, that public vehicle is their primary means of liquidity. So trading at these levels is problematic from a liquidity standpoint. And this is really just intended to demonstrate that very few of the BDCs are operating above 1.0. So the vast majority of the space, with where they're trading today, is constrained with liquidity. And so this is just one last look. It just emphasizes the periods of growth again. 2002 to 2007, you had 15 IPOs, about 15 more in 2011 to 14. And what you can see in 2015, equity raising was at a 10-year low. And if you adjust this for the fact that the industry was substantially larger then, it was actually lower than 2002. 2016 doesn't look a lot better. with where they're trading right now. There will be some activity likely, and there could be some new formation, potentially there's speculation. But it looks like this is going to be a period of consolidation potentially and of retrenching for the BDCs. So with that, Bob Long, I'd like to open it up to you as a former manager of a BDC. Just help the group understand what these managers are dealing with as they see stocks that are trading at those levels.
Sure. Well, I think there are a couple of things going on. As a manager of a small BDC, and before that as a manager of a closed-end fund in Europe, you obviously face the stock buyback question. And in both the firms that I ran, we did buy back stock, and at least in one case very aggressively. But as you pointed out, stock buybacks have pros and cons, and not just for the manager, right? They reduce, the smaller BDCs already trade in a more challenged way. So reducing your liquidity by buying back stock, reducing your size, does have a cost to your shareholders that offsets the accretion benefits, and not fully offsets, but there is a pro and a con, and as boards approach these decisions, they have to think really carefully about them. I think the existential question for BDCs, and I haven't seen John Bach's piece, I look forward to seeing that, is are they fundamentally closed-end funds that will suffer from the closed-end fund problem that if you're around BDCs or closed-end funds, generally you hear a lot, perennially trade at a discount? And I think the answer to that is yes and no. It is yes if the manager cannot provide access to assets that investors cannot otherwise get. So the most closed-end funds, as we know, are just a package of assets that investors generally have otherwise access to. You slap on a lot of fees, you make them illiquid, of course they trade at a discount. But for managers who can provide investors access to assets with a risk reward that is attractive and that they would not otherwise get, then I think the long-term cycle for BDCs is actually very positive. As I look around the world, lots of negative nominal interest rate securities out there and negative real rate securities for most sovereigns in the world today. So I think the thirst for yield continues for a long time, and BDCs have a great place to play in that, but only if they can add distinctive value. I'll stop there.
Okay, interesting. So so stock buybacks is one choice, one alternative. Another is improving credit quality. So trying to upgrade the quality of the portfolio, which can mean several things. For some, it means moving up market, moving away from the lower middle market, moving to more first lien, away from second lien, and just generally keeping the credit screen tighter. I throw it out to the group. Are you seeing, as you're in the market and doing deals, are you seeing evidence of that, of BDCs changing the credit screen?
Well, I'll take a contrarian view and say no, that most of these BDCs have high dividends. They're in trouble, they're trying to keep their dividends going. So they actually chase more yield to get higher rated loans when the market's tight, compounding their credit problems. I mean, that's really what a lot of them are doing. They almost shut down their senior and their second lien, and they have to do 12 or 13%. You show them a loan that's pretty good, and like, I can only do it if it's at this price. And that's just one deal, but you can just tell their mentality is, I'm chasing yield now even more so than I should, because I want to keep my dividend going. And so they actually could lead to more trouble in the future, in my opinion, at least on a handful of them. And the smaller the shop, the worse the problem, because they might only have 40 loans in a portfolio versus 100 or 200 based on the size of the BDC. Right. And you get a couple of non-accrual, and you can trade far below book.
And the smaller BDCs have more retail investors who, on that tension between net asset value growth and dividend, are more focused on dividend. So they're even more subject to the problem that you described, or the tendency you described.
Yeah, I mean, we see quite a few of the BDCs in our processes, and I would say there are some, to Jason's point, that will always chase yield. They have to in order to deliver the type of return that they've promised to their investors, and it is kind of a snowballing effect, especially for the smaller ones. And I think it tends to be the smaller ones that tend to have more of a yield chasing mentality. I think then you have firms like Golub and Ares and some of the larger groups that have, I think, gravitated more toward first lien and unitranche up the balance sheet, larger companies, higher quality credits. So you have some that are pursuing that strategy. You have some that are always going to be yield hungry, and you have some that I think are really just trying to survive. I mean, they're just treading water right now. And we used to refer to zombie private equity funds that weren't able to raise another fund. I think a number of these, particularly the smaller ones, I would categorize as sort of zombie BDCs that are just recycling what they have and trying to live another day.
I mean, Jason, you bring up a good point. I would agree with kind of your contrarian view. The cynic would believe that the model is fundamentally broken, because if you're not to scale, I mean, TVG did a good job by getting to scale before they went public. What is the critical mass where a Me Too BDC at $300 million of capital is really never going to survive correctly, unless they have a lucky credit market and they are able to take some risks and it just works out okay? Where do you guys see it as, and maybe Bob, a good question for you, is there a critical mass AUM diversity in the portfolio that says this is going to work versus someone just trying to float a $200 million BDC?
Well, I'm not an expert, but I read these research reports for a couple of years, and my instincts are, I know and I have to be obviously very thoughtful about what I say, not in that role anymore, but I think if you look at these smaller BDCs, all of them have thought about re-IPOing, which in one way or the other. My view, and I think the view of others, is don't bother unless you can get to $400 million of expected trading value, that there was a break point there. You're still not going to get the mutual funds as investors at that size, but I think I would not recommend taking the reputational hit of a dilutive stock grip, dilutive capital raise, because that's what's required. That's what these guys are going to have to do, unless you get to size, because you're not going to have done anything for your investors, and ultimately that's not going to help you.
I think another thing people should try to do is not IPO until 50% of their capital is not their BDC. So have a diversified pool of financing sources, whether it's from some CLOs or a private fund or separate accounts, an anchor insurance company, so that even if you IPO and your BDC doesn't trade well, you have diversity of capital. Because Dan hit this, but a lot of public BDCs probably have, 70 to 100% of their capital in the BDC. And when they trade below NAV, they're kind of paralyzed. They're living off redemptions. I know there's a guy from Apollo here, but Patrick Dalton, like 4 years ago when he was there, said, "Oh, now you guys have IPO'd, and now what?" And and a lot of them are the ones that are probably in that 70 cents and below category of they never got to scale. So everybody was rushing to get public when it was kind of the trendy thing to do, and your costs go up and your admin stuff goes up unless you really ramp up your origination. If you trade below NAV too quickly, all of a sudden you're really hamstrung unless you have other pools of capital to put new deals into.
And let's think about that. So imagine you get public, you trade, and then you're going to try to raise a private fund. Why should I invest in your private fund? You're trading below NAV. I like you. I can buy that. So
More liquid to be in the BDC as well.
Right, and it's at a discount, or they think it's going to be at a discount.
It's interesting. People forget in 2009, or just as context, in 2009, the BDC business model was declared dead. It was, these are by some. These are going to liquidate. This business model is flawed. It's going to go away. 2010, it literally reversed. They were the only model that had any liquidity and had access to liquidity, because private credit investors didn't want illiquidity. It was a dirty word coming out of the financial crisis. So it very quickly came into vogue, and you had a lot of people rush and get public, and now we're dealing with that, figuring out which are going to be the survivors. And so I guess that brings up the next point, which is one of the things that spotlight shining on the space has brought is shareholder activism. And so you're now seeing and hearing more examples of big guys, guys that you would not have seen investing in BDCs historically, big investors, but just generally activism in the boardroom. Just be curious for what you guys think. How is this, what's happening, and how does this play out? I'll open it up.
It's a hard question, because I don't think we've really seen anything happen as a result of the shareholder activism that has occurred out there. And maybe Bob, this is the point that you were making. It's, you know, you think about, well, who's gonna buy a BDC? I mean, there's no reason for a buyer to come in and buy a BDC for one times NAV or anything above 1 times NAV when they could buy the shares in the public market for less than 1 times NAV. And there's no reason for the BDC manager to sell at below 1 times NAV unless they're absolutely forced to do so. And I don't think we've seen the shareholder activism yet be able to force anything to happen. So I think the jury's still out.
I mean, to that point, you've
as far
got
as how that ends.
yeah, you've got the old BDC model and it's evolving and changing, but historically the boards of all these BDCs are set up with friends and family of guys that they're not going to vote against the chairman, and so the fiduciary responsibility conversation really gets thrown out the window when you're talking about, okay, the board's not going to vote in favor of selling at a discount because they're basically in cahoots with the CEO of the company. Never say that exactly that way, but fundamentally that's the reason why I don't think you've seen a lot of trading going on, because there hasn't been that catalyst. That's changing. I think people are getting wise to the model and kind of how that works, but I don't know if you guys have seen it differently, but anytime we've made a bid at one, and historically the price is at a far premium to where it's trading, but no one's selling. I mean, as a manager of BDC, you are reaping a very nice payment stream, and for you to sell it, it's got to be, to your point, close to par, if not at premium, which is crazy when it's trading at 70 cents.
And think about it, if you are one of those directors, let's assume you are professional and objective. So you just approved the NAV of X, and now you want to buy it at X minus. Puts them in a hard spot.
Absolutely.
Particularly if there's a material difference. And to your other point, so typical BDC, I looked today, I think the end of last week was small ones, 80-ish% of NAV. Okay, so typical, you call them zombies, I won't disagree with that term, $200 million market cap. So you're a real investor, you want to buy $5 million of that stock? You're not buying it at 80, you're driving it to 90 like that.
Yep.
So it's a really interesting situation where it's supposedly liquid, but the price on the screen, you really couldn't accumulate very much.
So does this take, are we talking quarters or years, or what's the time frame that this plays out over?
I think it's years. Kevin highlighted economics. If you're in the GP economics and you can run flat and live off redemptions, you're still making a ton of money. Now you might lose employees that aren't in the GP that want to do more deals every year, so you probably see a lot more employee churn. But unless you really have some of these real lawsuits, which are really less business oriented and more ethical in nature, I think a lot of these people will run in place, and then you look at some of the the potential acquisitions and kind of what the frenzy it's caused, and really there hasn't been any real transactions. I mean, in history, I guess, Ares buying Allied in 2006 was probably the most successful one. And I didn't even study on this, but I don't know, tell me if I'm missing some other
There was another
BDCs.
small one.
Prospect and Patriot.
Okay,
Patriot
right.
fair
Prospect.
point.
Yeah.
Right. So, 2.
Which was very successful.
Right, and there probably should be, over 10 in terms of a going concern on the guys that are trading below book that never have a chance of seeing, par anytime soon. But if you're there, if I was the CEO, I'd just be on that treadmill, quarterly, annually.
Yeah.
I'm making okay money, trying to keep my portfolio flat.
Holistically, it's going to take quarters, years, unless regulatory reform comes in, because one of those 40 has done something extremely against the law, or has their marks done in a very poor way, which there's a lot of third-party fundamental valuations done now, so it's probably less and less as time goes on, but you could have one major BDC with major legality issue evaluation, which could blow up a lot of situations and hurt everybody. And I think that's the one catalyst that I can see happening in a shorter time period than kind of the whole industry kind of consolidating quickly. I just don't see that happening unless there's short regulatory reform.
The only other thing I could think of on the positive side to drive the stock prices up is it does seem like the interest from the broader investment public in the BDCs is pretty heavily tied to interest rates. And so if we do get into a period where interest rates are rising every quarter and people feel like there's there's real momentum and that there's going to be a lot of interest rate increases, then that could cause people to become interested again in the BDC sector and drive the prices up. One other thing just to throw out on the other side of the coin, I think historically the BDC managers got surprised by being taken out of those broad indexes, and that's really
That was
really
crushing.
hurt the sector. I mean, that's a really hard thing to recover from.
So two observations. One, imagine one of you wants to acquire a BDC. Well, you acquire the management contract. First of all, you can't acquire from the manager. It's an asset of the BDC. Second, if you have it transferred to you, as we did at Oak Hill from NGP, then you're still subject to the 40 Act, which you guys may not live in all day long. I have. And it's terminable immediately without penalty. So not a huge incentive. Next, to the question of how long, there's a parallel market in Europe, somewhat parallel, where Conversus was listed private equity funds. So the firms like PIP, which is Pantheon, you guys probably know Pantheon, a well-respected fund of funds manager here in the US, actually based in London. They've had a vehicle, PIP, the symbol's PIN. It's outpaced the FTSE hundreds of basis points for decades. In terms of its NAV growth, it sort of generated fund-to-funds type returns, 20% discount to NAV, and it's traded there consistently. Partners Group has one called Princess, pays an 8% dividend, might be a buy, 16, 17% discount to NAV. So I lived that market, and we sold Conversus, I won't go too much into that, because we produced good returns but traded at a discount. These other guys, there are many good managers who produced good returns for a long period of time in Western Europe, and it hasn't changed. It hasn't changed.
Was it fair to even look at American Capital? I mean, I like the firm, I look at friends there. They've been below book for 8, 10 years.
Yeah.
They've been buying shares from 60 cents to 80 cents for 5 years. And now, 2016, they finally have an iBanker and they might trade, who knows, but at least been announced. Look how long that's taken.
Right.
So,
Right.
almost a decade.
No, absolutely.
Now they're
So-
bigger, but
So no, that's interesting. So let's talk about what that means. So I think we've heard panel things in terms of what's happening, how long it'll take, and just in terms of what that means for the market. Gold Sheets released their quarterly outlook a couple weeks ago, and one of the statements here I'm just going to read because I thought it's a good way to frame the discussion. So they're talking about the challenges in the space and the downgrades, or some recent downgrades by Fitch and Moody's. And their statement is, as a result, market participants expect BDC liquidity to remain constrained for the balance of the year, with many being very selective in which deals they can and cannot do. Are you guys seeing that in terms of their activity level? Or do you anticipate that?
I think it depends on size. And to Jason's point, the diversity of funding sources. I mean, what we see is the larger, more diverse BDCs really haven't been impacted that much by the fact that they're a BDC or not. It's we can have a different discussion about credit and where we are in the credit cycle and what kind of decisions lenders are making based on that. But I think we see the larger, more diversified BDCs acting pretty much the same. But as you go down the scale in terms of size, then you start to see ones that really are more capital constrained, and as a result, you don't see them as much in the market certainly as you did in 2014, 2015.
So, Kevin, I'd be curious. I was surprised. I was in Asia recently doing some fundraising, on a roadshow, doing some fundraising meetings, and did not know what the level of awareness would be with sponsor finance, BDCs, lower middle market, and was shocked at how aware people are of the BDCs and of the challenges. Be curious if you've seen or heard from investors as you're out talking to folks, if they're aware of what's really going on.
Yeah, no, they are. I think when we're out fundraising consistently now, so you get that question all the time, why should I invest in a illiquid credit fund versus a publicly traded BDC at a discount, no less? And I obviously, counter that with the credit quality of the deals that we're doing, what we're putting into our book. I think fundamentally the major defense of that, and to Jason's point before about kind of deployment of assets, anytime you are fundamentally forced to put money to work because you got to pay a quarterly dividend to keep the chain going, fundamentally I think you either need to stretch into deeper parts of the capital structure to get your yield, which I think we were talking about before, or your credit quality skills and your covenants and the things that you kind of hold true as a credit investor either go out the window or you kind of look the other way on a lot of things. And so I would say fundamentally the reason why I think the BDC index trades where it does is because you have a lot of second lien and mezz in a vehicle or people I think expect to be more senior in the capital structure. And I think when you really dig into kind of the underlying credits and the valuations, you've got poorer credit quality type assets than you think you're getting. So from what I basically trade off of that is we're more senior secured top of the capital structure. That's the difference in what we do. There's less liquidity in what we do. There's no question about that. You can't just trade and get out. But I think some of people's points on the panel, liquidity is only the moment you try to get it if you can actually sell it. And I think we've all seen that through credit cycles, through BDCs coming out. I was at American Capital when share price went from $30 to $9 in 2 weeks because there were activists there. And the world changes quite dramatically when you think about liquidity when that happens. And that sometimes is not in your control. So I never kind of view the liquidity of a BDC versus the illiquidity of a platform like ours to be the underlying fundamental reason why you invest. I think you're investing in quality of the credits. And I think, again, if you're forced to put money to work, you're going to make bad decisions at some point. And you may ride it out in a good cycle, but when, look at people's track record through 2007, 2009, how did they do? And I think you'll have a good sense for how they're going to do the next 2 years.
And I think just on that, some regarding transparency. I think if you go back 6-7 years ago, insurance companies didn't do floating rate loans, endowments didn't do them, pensions didn't do them. And a lot of asset managers, when the CLO market was closed coming out of the recession, were going beating on doors like everybody up here has to be like, here's my firm, here's what we do, and here's what a senior rate loan is. And everybody's like, well, I only do private equity and high yield. That's my alternative bucket. And if the 40 of us, the 40 public BDCs went through, there's probably 40 other firms that didn't make it through. But all of these people now, Asia, Japan, Middle East, domestically, everyone's probably had 50 different asset managers go through their offices and tell them how they're different, how they're unique. And so I think our industry has a lot more of an understanding and transparency. And also now, the more public, you have some of these sharper, equity analysts like Bach who looks in your portfolio and says, hey, Mr. So-and-so, you're 22% energy. That's got to be bad news for you. And if you go to the LP meetings, right? If I'm the CEO and you're all my LPs, I'm probably going to come up there and sell you a lot of sunshine, even if things are a little rocky behind the scenes, right? It's just the nature of it. But now, if Kevin was a reporter and he's looking at my stuff and he knows my loans, and he's out there publishing independent research that says, hey, Van Dussen's portfolio has some cracks in it. He might not have told you that at your LP meeting, but oh, by the way, I've looked and he's got something in the Permian Basin, he's got some stuff in oil sands in Canada, and that stuff is toxic. He'd be lucky to get cents on the dollar. That is the reason now these stock prices are where they are. There's more transparency now. You can't just sort of bamboozle your LP base with flowery stuff about how things are going. They're smarter. You got independent people that are publishing more data, and so I think everyone has a better sense of peeling back that onion into your portfolio. Where are you playing? How much do you have in junior versus senior versus certain sectors? And I think it's reflective in the stock prices of how these guys are trading because people are smarter, making independent decisions now about who they want to back.
I think that's a good point. The disclosure of your portfolio, BDC or non-BDC, when we were at Fortress, they didn't know anything in our portfolio. We would never say anything, any individual credit conversation was never a part of the conversation. Now, they're like, walk me through every credit in your portfolio. It's a very, I don't think they understand half the things I'm saying, but at the same time, they're like, tell me what's in there, and it should make me feel like you know what you're talking about. And I think that's a different part of the world right now, in a good way. I mean, I think the LP should understand, have transparency to what you're doing. It shouldn't hide anything. It's if you're doing what you said you're going to do, it's pretty easy.
Yeah, it's great for the investors that have more transparency now who didn't before.
So let's round out talk about BDCs and the trends there. Let's round out the discussion on the supply of credit sort of in the near term. So what are you seeing from other players, the banks, CLOs, hedge funds, private credit funds? What are you seeing in terms of their level of activity? Are they active? Are there, which elements are getting more active and less active?
we've been talking about size. I bifurcated. You have to bifurcate it by size to market. I think, at Highbridge we were running, a $7 billion book in our last iteration. You were doing $100+ million checks. That market is still very active. There was 3 players doing it 5 years ago. There's probably 25 players doing it today. So I think there's a lot more competition in that space, and Bob can probably enjoys that level of competition amongst all of us. But so I think that's been a pretty active space. Banks I haven't seen to be really involved in the market in a meaningful way anymore. So I think that's been filled up by the larger funds out there. On the smaller end, kind of where I'm playing right now, it's gotten better from a competitive dynamic. BDCs are a little bit, the guys who are just fundamentally only a BDC, not as aggressive as they once were. So I don't know how many books you sent out, but if you're looking at down to 4 or 5 guys who are competing, you get the call back now where you maybe didn't get the call back 6 months ago. So I think it's active credit quality and credit in the first 2 months of the year. Historically, I always find it slow anyway, so it's been, I think, a slow Q1. We found a couple interesting things, but overall, it's a lumpy business, and I'd say it's kind of where it has been historically, but competition seems a little less out there for the lower end of the middle market anyway.
Yeah, well, I'll hit the higher end, and I think, I don't know if the tone seems negative on BDCs. I think it's very positive that this asset class has taken share from banks that have been regulated, over the past 3, 4, 5 years, and really that's kind of been the shift, right? The deals the banks can't do, the FinCos, the BDCs, sort of the non-regulated, that's where the loans have gone in general, right? So that's why you see 40 public BDCs. Before things got a little rocky out there, they all had enough deal flow to survive and were doing well probably 2 or 3 years ago. So I think there's still a fundamental shift in the capital base again. If you're an LP, it's a different story, but if you're employing, you're running in place, so to speak, and you're churning $100 million, but you're putting $100 million to work, that's still fine, and you're going to weather the storm. If your portfolio stays clean, you'll be okay. So, but in the upper middle market, so the BDCs is good, and they're playing, from the lower middle market deals to the lower middle market deals. So Golub, our BDC, is probably, 25-30% of our capital, but we've seen a ton of deals in the $50 to $100 million space, which, a year ago we might have had one. We've closed a couple, and right now, if I have a pipeline of 35 deals, I think 20 of them are above 50 million of EBITDA. And it's like, I'm talking to you and Jefferies, or you and UBS, or you and Goldman Sachs, which is crazy. But that's kind of who they're talking to now, because someone's licking their chops from a deal they just lost money on in the BSL market, and really it's not just amount to 7 iBanks anymore. It's, Guggenheim's in the mix, and Ares in the mix, and ourselves, and other bigger FinCos that kind of have balance sheets that are relatively healthy with some iBanks. But it's really changed a lot. So there's a lot less deal flow, Dan, in your question. And the competition, I feel, is narrower. The firms that are doing, better, I think, just have diversified capital sources to pursue it, because even the banks right now are still hurting from, every one of them lost money in the last 6 months, and some of them lost a lot of money, you guys saw. A lot of them have had massive layoffs announced in the last couple months. So there's a ton of great human capital out there as well. And I see a lot of those will probably try to raise money soon. Like, hey, I've been an iBanker for 25 years, I know credit. Why go work for some other big firm again? Why don't I try to go hook up with somebody else as my anchor and go start my own firm? Because if it's successful, it's very profitable.
Yeah, I think there's been some real structural changes in the primary players that have been historically, the anchors in the broadly syndicated market. You've got the banks, which are facing the regulatory issues that they have, but then you also have the CLOs and the prime rate mutual funds, which historically have comprised most of the buyer universe for that paper. And the CLOs are facing their own regulatory issues with the risk retention rules going into effect. New CLO formation is down dramatically, and so if you don't have the arranger banks that are able to do what they used to do, and you don't have the CLOs who were 2/3 of the buyers of that paper not able to do what they're able to do, it really does open up opportunities for firms like Jason's or some of the other large middle market players to go into that $50 to $100 million EBITDA zip code and club deals together the way that, you know, historically middle market deals have been done all the time, because you guys and others have spent the last 3 or 4 years of your lives building up ways to increase your hold sizes, and so now there's definitely enough depth in what had historically been middle market players to step into that, you know, 500, 600, 700 million dollar credit facility arena and get club deals done in that market.
Can I digress on CLOs for
Please.
a second? So, I don't know if you're familiar with CLO asset owners, but they have kind of a weighted average risk factor. It's called a WARF. And as they have downgrades, you know, that number goes down, and they have compliance with both Moody's and S&P about what they need to be to continue to make new deals. And I think between energy and some downgrades, defaults being up a little bit, people are concerned about their B3 or CCC buckets. So those are kind of the lowest two areas they could have, and still, you know, they have a limitation for both. And so right now, the reason I'm bringing up the story is the B3 buckets are full for almost every asset manager out there. Like, to get a B3 through the market today would be very difficult. It would probably price wide. In a lot of CLOs, you could tell them that, you know, I have a holdco PIK note for Apple at 5%, and it's a B3, and I can't do it, right? And it's just, you know, it's kind of like illogical, but they're constrained. And so for firms like ours and others, you know, there could be this, you know, rougher deal in the market. I try to use my word selectively. It's going to be cyclical. It's lower levered, but it got a B2. And all of a sudden, you know, the book gets oversubscribed, and you got some great software deal that got bought for 15 times, and it got a B3, and the market can't buy it. So one deal gaps out to like LIBOR 600, 650. Kevin and I take $50 million a piece. We call one another, and we're like, wow, this is great. And some other deal that's a B2, that's a cyclical, you know, it's going to have a downturn, clears at 525, and it's all this sort of technical wharf management stuff. And I get it. At the same time, you take a step back, and like, it doesn't make any sense if you're just looking at return on, you know, risk-adjusted return without any technical limitations on it. So the good news about the BDC asset class, why we only have 1 times leverage, we don't have a lot of the wharf and a lot of the other stuff, and even a lot of the CLO stuff. So sometimes we pick our spots. We can do a big ticket on a very attractive trade once in a while, based on some of these technical sort of issues that present itself in the marketplace today that really don't make a lot of logical sense, and no good PM would look at both deals and say they're equal, but they're going to say, gosh, I can only buy this one, I can't buy this one. And for us to have more flexibility, you know, we're all over that other trade, so it just seems to be, you know, a screaming buy. It's kind of like, well, I've stated the case.
No, absolutely. So, and I think Kevin talked about getting callbacks that he wasn't getting before, and I can tell you, I have a lot more friends today than I had a year ago. A lot more people want to meet with me, want to see me, and that's, you know, hopefully that's a good sign, and more than just my charm. Thank you guys. Appreciate your time and input.